Hi, this is Dr. Prakash. Welcome to my show and Happy New Year. This is the first video in 2023. So let's start with the charts. Let me share them. Okay. Share. Okay. All right. So what we are doing here is we are going to take a look at what is the market outlook for 2023. We all know that we had a very bad year in 2022. The market had a severe downturn, and a lot of people had a very bad return. So what is the market going to be in 2023? Is it going to be better or is it going to be the same? So we'll go through that, some of the scenarios there, okay? And also I'll evaluate 4 stocks to consider for this week, okay? So let's look at the 2022. The market was very high in the beginning of the year, 4796. And then it went down to 38.39 at the end of the year. So that was nearly 20% down in terms of price itself. But if you include the dividend, the total return for S&P 500 last year was minus 18%. Now, it was not a straight line, obviously. It went up and down, and there were several reasons why the market went down. The culprits were the inflation, 40-year high inflation, geopolitics, Russia invading Ukraine, and then the Fed rate increases, Federal Reserve Bank trying to bring the inflation down by increasing the interest rate. So all those contributed to this downturn. Now, in between, the market did get optimistic that the Fed would pause or Fed would pivot, and that kind of took the market up. But then the Fed Chairman Powell came and gave a hawkish outlook for the interest rate, and the market kept coming down. So that was a story last year. So now all sectors did not face the same downturn. The energy sector did very well. It was up more than 50%. The tech sector, the communication services sector, and the consumer discretionary sector, they all had very bad return. Now, if you were lucky enough to underweight these sectors in the beginning of the year in 2022, and if you were to overweight energy and let's say healthcare and consumer staples, which also did fairly okay, you would have done much better than the market, and you actually would have gotten positive return. Or if you're one of the lucky ones, you had moved a lot of your tech stocks and communication services stocks into cash in the beginning of the year and had strategically entered the market when these downturns happened, then you would have done very well also. So the moral of this story here is you need to have some sort of game plan going into the year, and for that we need a forecast for what is the most probable or most likelihood scenario for 2023. So that's what I'll talk about next. So for 2023, the market is going to start okay in January. And we already saw that last week, right? The market had a very good upward movement on Friday because we got the labor data, the employment data. Although the employment data looked like it was going to encourage Federal Reserve Bank to be hawkish, there was one piece of data which was a wage growth, which was better than expected or lower than expected. So the market took that as a good sign that would force the federal government to go easy. Okay, so the market may not be reading that right, but at least for January, there's going to be mixed data. And then the market has this tendency to look at the bright side. And I think for this month, the market is going to do fairly okay. And then the Federal Reserve Bank meeting comes February 1st, and Jay Powell is going to give his speech again. is going to be hawkish again. And then at the same time, the fourth quarter 2022 earnings come out, and more than the earnings itself, the guidance for 2023 comes out, and the guidance is not going to be good for many of the companies. And so the analysts will start re-rating the stocks, right? The EPS comes down, the EPS consensus comes down, and the market starts going down. So I think the market will face a very bad environment in the second quarter and beginning of the third quarter. So the forecast, the model I built is saying that somewhere between April and June, the market will hit a low of around 3,100, which is lower than what we had for the low last year, which is around slightly less than 2,500. And then the market starts recovering somewhat, and the real recovery starts in the fourth quarter. So in this scenario, the market, the forecast is saying by the end of the year, the S&P 500 will be around 4,100. And also the market is, not the market, the model has this forecast of a recession happening somewhere between 2Q and 3Q. It probably will start towards the end of 2Q, and then it will go through 3Q, and maybe it will end somewhere during 4Q. So in this scenario, if this is the forecast we have, if this is the most likelihood forecast, or the trajectory we have, what should we be doing? So we should be cautious in the beginning of the year, not by any, not be tempted to buy stocks, many stocks here. Maybe strategically you can do some covered calls and covered puts. But then you may also want to allocate a little bit of excess cash here. Again, the tech sector is not going to do good even this year, I can tell you that. So you may want to reduce your tech sector and then use that cash to enter, strategically into the stocks that are going to do good in other sectors in this April, May, June timeframe, when the market will really have a tough time, right? So even if you did not do any of those, and if you just, invested in SPY in the beginning of this year, by the end of this year, you will have a 7% return according to this forecast. And the total return would be around 9%, right? So once we have this forecast of the scenario, so, we have to watch it, periodically update it and adjust our strategy accordingly, okay? All right, so what are the 4 stocks I have selected for this session? So there are 2 in technology and 2 in healthcare. So the technology, as I said, is going to have a rough time, but there are some stocks which are going to enter some rough patches, and you can buy some of them. And I have selected 2 of them. One is Apple, and the other one is Palo Alto Networks. In the healthcare, which I think will do reasonably good even this year, I've selected 2 of them. One is CVS, which is a, everybody knows it as a drug chain, but they also own a healthcare insurance company, Aetna, and they're also in distribution of drugs, etc. And then the other one is United Healthcare, which is a big healthcare insurance company. Most of you know that. Then, so what's happening with Apple? Apple has come down a lot, and on Friday it was actually 129. You can remember in the beginning of the year it was around 170, I think, or above 170. So it has taken a lot of beating. The reason is people are worried about the iPhone shipments and the iPhone sales, iPhone 14 sales. Now, Apple does a lot of stuff. It has MacBook, it has iPhone, it has, the whole ecosystem built around iPhone. But the problem is most of their profit comes from iPhones. So even if there's a small drop in iPhone shipments or iPhone sales, their earnings will come down. That's what the market is worried about. So they may have a somewhat bad earnings report at the end of this quarter, in January, at the end of this month rather. And then they may also give a somewhat soft guidance. So the stock may go down further, And that may create some good opportunities for you to enter Apple stock. The consensus EPS right now is 6.2, but I have a feeling it will come down to around $6, when they give the new guidance. And then right now their P is around 21 if you look at the last 12 months. And the low PE forecast, my model is saying is around 18 to 19. So with that type of a forecast, the stock will come as low as $100. And the low is somewhere between 100 and 110. So that's the area where you can buy some Apple stocks. Okay. The next stock I have is the Palo Alto Networks. The Palo Alto Networks is in a good space in terms of software, which is cybersecurity. Now, Palo Alto Network, sells their software to enterprises mostly. The enterprises are going through some budget cuts because of the looming recession, so they will cut down on their capex. But since Palo Alto Network is in the cybersecurity space, the capex that is going to be cut, or the expense that is going to be cut in the cybersecurity space is going to be limited. So Palo Alto Network will do reasonably good. So right now their stock is 134.85, which is also very low. It's almost, in fact, they hit the 52-week low last week. And the consensus EPS for them is around 3.4. And the TTM, or the last 12 month PE is around 50. So they're given a very high PE because they're considered a high growth stock, and they're also in a growing market segment. Okay. In the recession environment, when the budgets are being cut, their P could be as low as 30 to 35. So when that happens, their stock will hit between 102 and 119. So that's the zone when you can buy Palo Alto Networks. And if you hold on to Palo Alto Networks and Apple for more than a year at 18 months, you will do, pretty good. And let's come to the healthcare. So healthcare, is a defensive sector. So it's always good to have, at least the market weight for healthcare, and maybe a little bit more than the market weight this year, given the recessionary fears, right? So CVS, as I said, is a healthcare conglomerate, really. It's in many, many things. They're in the drugstore, they're in this minute clinic, I think they call it. And then they have Aetna, which is an insurance company. So they're in lots of things. So their market closing was 91.6 on Friday, which is actually pretty close to their 52-week. Their 52-week was around 86, I think. Their consensus EPS right now is 8.6 for the next 12 months. They will come very close to that because in healthcare, people keep spending. America is getting older and the healthcare expenditures keep going up. So they'll probably meet that. Their current PE, the last 12 months is 38 because they really didn't have, the right earnings reported last year because of write-offs and stuff like that. And the low PE forecast for them is between 9 and 10, right? And these defensive stocks don't have a lot of high PE anyway. So at that PE, their low can be anywhere between 77 and 86. So, it will be lower than what the low was last year. So that's when you should be entering CVS. And another good thing about CVS is they pay a good dividend, around 2.6%, and they keep increasing that dividend. So it's a dividend growth stock. So it's a good defensive stock to own, and that should be your entry point. Okay. The second one in the healthcare segment I have is United Healthcare, UNH, and they closed Friday on 490, and they're a big company, and the earnings are very high. They make around $25 per share. They're forecasted to make around $25 per share in 2023, and their P looking back is around 24. But I think this year, because of recessionary fears and also, regulatory uncertainty, because when you are in healthcare, regulation matters a lot for insurance companies. And we have had a change in the government. We have Republicans controlling the House. So we don't know how all that works out in terms of regulation. So there's some uncertainty there. Their PE, the low PE, can be anywhere between 16 and 17. So what that tells you is in the next 3 to 6 months, they could hit a low of 400 to 425. So all these four stocks, are good stocks to buy. Right now is not the time to buy that stock. Wait for 3 months or maybe a little bit more than 3 months, and you will see these prices, and then you would go and pick up those stocks. Okay. So let me throw some more color on these stocks. Okay. So Apple. Okay. How did they do last year? They went down 25%. Okay. Their high was 179 and their low was 124, which hit very, few days ago, right? And even Apple, see, it went up and down because, when there was Fed being hawkish and when the whole market was going down, nobody's immune. Even Apple went down. And when the market got optimistic because the Fed may pivot, then it started going up. So just because Apple is a great stock, you just don't want to enter the wrong time. So that's the moral of the story. And you can enter when around 110, 105. I told you that. And then if you do that, you'll have the high for this year is forecasted to be around 165 in the model. So you could have 50% total return. So you just have to be patient. Okay. The next one is the Palo Alto networks. So you can see they also went up and down, but they actually held up a little bit until the last month, and now they have come down a lot, right? And again, uncertainty about the capex in enterprises, right? And here, the forecast for the high for this year is going to be around 155, not as much as last year when it was 213, because the P's are getting compressed. And if you enter the stock for the low I gave you, and if you hold on to 12 or 18 months, you are going to make more than 35% in return. So let's look at CVS. Now, again, CVS has gone down, even though it is a healthcare company and even though it is a defensive sector, but less than the market, half of what the market, or nearly half of what the market, slightly more than half of the market downtown. So their forecasted high is again for this year is 111, same as last year. So if you buy them, around 80 or less than 80, you are going to have almost 40% return on CVS, right? And then the last one is UHC. They actually did pretty good last year, 4.3% compared to S&P 500, which was down 20%, right? So that was a good start to own last year. Their high was 558, the low was 445, and this year we are saying the low could be as much as 400. So the forecasted high this year is very close to what happened last year, which is around 550. So you have a potential of 35% return. They also pay a good dividend, and they also increase the dividend every year. So that's another, dividend growth stock, you may want to own. So when you look at how they have behaved over the last 12 months and what the market or the model is forecasting, so what you can see is these four stocks are excellent stocks to own, but you have to be patient and look for those market lows. The scenario is giving us, and when the market lows happen and when they enter the buy zone, I talked about in the first chart, in the second chart, you can start accumulating those charts. Okay. All right. So that should complete the presentation this week. And next week we'll come back and we'll talk about a few more stocks. So thank you very much. And we will talk again next week. Okay. Thanks. All right. So we stop it here.